Hello everyone, and welcome to the Automatic Wealth Academy. So today we are going to be diving into a powerful investment philosophy that has helped some of the most successful investors in history achieve financial freedom and grow their wealth exponentially. I'm talking about the simple but effective principle of holding on to your winners. Something that has been a cornerstone of Peter Lynch's investment strategy. So, why is it so important, and why should so many investors follow this principle? And why do so many investors miss this crucial point? So in this video, we're going to explore how Peter Lynch, how he managed to achieve a 29% average annual return, and we'll see how it is largely attributed to his philosophy of letting his winning stocks run, and why doing the opposite on the other side, selling them too soon and holding on to your losing stocks, can significantly hinder your returns. We will see why most investors fail on holding on to their winners and why it's crucial to avoid this big mistake. We will see the psychology behind we sell winners too soon and cling to the losers. We will see real-life stories of investors who either applied or ignored this principle. And we'll see some practical takeaways for different types of investors, whether you're just starting out or are already an experienced trader. Okay, so let's get started with the video. Peter Lynch was a manager at the Magellan Fund at Fidelity Investments, and he delivered an astonishing 29% annual return over a period of 13 years. This is astronomical. This performance is more than double the return of the S&P 500, which is one of the most reliable benchmarks for investors. But Lynch didn't use any complex algorithm or intricate models to achieve these returns. Instead, his strategy was based on a few simple principles, with one of them, and one of the most important one actually, being hold your winners. Okay, so this leads us up to his most famous quote, or one of his most famous quotes. Selling your winners and holding your losers, it's like cutting the flowers and watering your weeds. This quote embodies the essence of Lynch's investment philosophy and serves as a warning against a very common mistake that investors make. And that mistake is selling too soon. Don't sell too soon. Don't. Sell if there are reasons, and obviously you must understand why you bought that stock in the first place, and that's another famous quote of Peter Lynch. But if you're sure your stock and you've done your homework, don't sell your winners too soon. So why do many investors make this mistake? This is think of it basically in this way. Imagine that you plant a garden and you have some flowers that are growing beautifully, but others are starting to die. What would you do? Would you water the flowers to help them grow, right? So you would water the flowers at the end of the day. But in the world of investing, on the other hand, people do the exact opposite. They cut their flowers, as Lynch said, their winners in investing terms, and they will start watering the weeds or the losers or the stocks that are actually losing in that moment. When a stock is performing well, investors often get nervous about losing their profits, and therefore they decide to sell. Meanwhile, what happens on the opposite direction if they start losing money? So they would actually start holding on to those unperforming stocks in the hope that they will eventually bounce back. Because ironically and psychologically also, selling a stock which is losing is like admitting defeat, basically. Okay. But anyway, we'll get into that. So what is the psychology behind the selling of the winners and holding on to your losers? Why do we do that? Why do most investors do that? So let's break it down. When a stock performs well, okay, so investors tend to worry about losing their gains. So this is rooted basically in loss aversion, no? Which means people fear losing more than they enjoy winning. So selling the winners early is a way to lock in the profits and avoid any potential pain of loss in the future. On the other hand, holding on to your losers is driven by the fear of regret. So investors feel that by selling a losing stock, they're acknowledging they made a mistake, like I just said a little while ago. This can be very painful. So they cling on to their losing investments, hoping that one day they will recover. Okay? But at the end of the day, selling that losing stock and maybe reinvesting it in a better stock, which will then help you to gain your losses, most times is a much better strategy. So several studies have also measured the cost of selling winners prematurely. And even more compelling is the case of Peter Lynch himself. So he famously admitted that some of his biggest mistakes were selling stocks like Home Depot and Walmart too early. After he sold them, both companies went on experiencing massive growth. So imagine how different his track record would have been and would have looked like if he had held on to those stocks even longer. Okay, so why do investors struggle again on holding these winners? Let's get back to that. So if the evidence clearly shows that holding on to your winners leads to better returns, why do investors struggle to do so? It all comes to psychological biases. Let's take a closer look at common biases that cause investors to sell their winners prematurely. Okay? So, loss aversion. People fear losing what they've gained, even though the potential rewards of holding are much greater in the long term. The fear of a market downturn can drive them to sell while still on the top. So in moments of uncertainty, in moments when there's a crisis, people tend to want to take home their profits. And even if the stock is up and they're earning money, they would panic sell and sell everything in the risk of losing their profits. So imagine you buy a stock at $100 and it rises to $150. That natural instinct is to sell and lock in those profits. But if you held on, it could potentially rise to $300 or more. So loss aversion keeps you from realizing that by selling too soon, you're forfeiting your bigger win. So this doesn't mean that you just have to hang on and go for the ride, not knowing where you're going. You must know why you bought that stock in the first place. You must have done your homework. You must know why. But most people just buy a stock because a neighbor said so. And this is always Peter Lynch's words. The neighbors talked and he said, they've given you a tip and you decide, oh, that's a good stock. Everybody, there's the fear of missing out kicking in, and you buy a stock. And the stock goes up, and from 100, like we just said, to 150, and you made money. Then something happens, some news comes out, the stock might even just go down from 150 to 130, 140, let's say, just a little bit. And then you don't know why you bought that damn stock in the first place. Okay? You don't know why you bought it. And you see it going down, you panic, and you sell it. Okay? So, okay, you must know what you're doing. You must know why the reason you bought that stock in the first place. But still, even in that case, that loss aversion kicks in. So that's when you have to psychologically be able to be strong. Anchoring. Investors then often anchor that price they initially paid for a stock. So once it reaches that level, they feel compelled to sell. This keeps them from understanding that stock value isn't really tied to the original price that you bought it at. It's about the company's future potentials. So just to give you an analogy, think of buying a pair of shoes for $100 and the next week they go on sale for $80. You don't want to buy them again because you already paid $100, even though they're still worth $80. Okay? So Anchoring doesn't allow you to see that the shoe's price isn't tied to the price you initially paid. It's based on its market value. Then you have the overconfidence. So after you've bought a stock, an investor often feel, or investors in general, let's say, often feel overly confident in their judgment. So if a stock falls, they attribute that decline to external factors, refusing to acknowledge that perhaps the company's fundamentals are changing. This leads to holding on to losers for far too long. Okay? So an example would be you buy a tech stock and it drops 20%. Then rather than reassessing the fundamentals of a company, you convince yourself that it's a long-term dip. That it's a short-term dip. Okay? And you hold on to the stock, hoping for it to recover. So your overconfidence clouds your judgment and you continue holding even though the company is struggling. So this would be holding on to your weeds. Okay? Then regret aversion. Nobody wants to make the wrong decision. So as I said before, selling a winning stock that continues to rise can cause regret. So investors hold losers, hoping they'll come back to avoid the regret of selling too soon. So, for example, you sell a stock and watch it continue to soar. Every time you see that stock in the news, you feel regret, wishing you had held it for longer. This fear regret often leads to holding stocks just to avoid the pain of realizing you sold it too early. Okay? So how to implement Peter Lynch's strategy? Now that you understand the psychology behind the mistake of selling winners too soon, let's discuss how you can apply Peter Lynch's philosophy in your own investment journey. So, here are some actual tips, okay, for holding on to your winners. So, invest first of all in what you know. Important. So, one of Lynch's main principles was to invest in companies that you understand. By thoroughly researching the company, therefore its products and its potential for growth, you'll have the confidence when the stock prices rise. And you'll be less likely to sell prematurely if you truly believe that the company has good long-term potential of success. So a real-life example would be when Warren Buffett bought Coca-Cola. So Warren Buffett has often said that he only invests in businesses that he understands. So one of his biggest successes was investing in Coca-Cola. He understood the company's potential and the power of the Coca-Cola brand. So by staying invested long-term, he saw incredible returns. Okay. Then another way of implementing his strategy would be to set clear criteria. So define your sell criteria before you buy a stock. This could be based on valuation levels, changes in company fundamentals, or other clear signals. By setting these criteria up front, you won't be swayed by short-term price fluctuations or emotions. So an example would be, before buying a stock, you ask yourself, what would make me sell this stock? Okay? Would it be a change of leadership, a major drop in earnings, or some other fundamental shift? All right. Then you could set price alerts. Don't get caught up in watching your stock price tick by tick. Instead, set price alerts that notify you when the stock hits key milestones. This way you can focus on doing your research rather than reacting to small price change. Avoid over concentration. Okay. Don't let any single stock take up too much of a portfolio. If one stock grows too much, it can make you feel more emotional about it when the market fluctuates. So having a diversified portfolio can help you weather those emotional storms and make better decisions. So this is a strategy. Obviously, I'm telling you, this is information I'm giving you and strategies to not sell your winners, okay? But there are different ideas on this concept, for example, of portfolio diversification or not. So in this point of view, Warren Buffett, for example, I'm going a bit off topic here, but I think it's important. Warren Buffett, for example, says that if you are an expert and you know what you're doing and you got the time to dedicate to your stocks, a very concentrated portfolio is to be chosen and makes sense. And we'll see this maybe on another video another time. While if you're just a normal investor and you don't have the time, apart from the fact that probably investing in a S&P 500 index would probably be the best choice. But if you still want to invest in stocks, a diversified portfolio will actually help you in protecting your investments. And also, in this case, will help you from not selling your winners, because each stock doesn't have that big weight on your portfolio in such a way that you will then feel the impact of fluctuations. So, another topic, another strategy or thing to focus on in order to be able not to sell your winners is focusing on the business fundamentals. So remember that stock prices should reflect the underlying business. So not just the short-term market fluctuations. So if the company is still growing and its fundamentals are strong, let your investments grow. Have a look at the track returns as a percentage. So tracking your returns in raw dollar amounts can often lead you to make decisions based on how much money you've made or lost. By tracking your returns as a percentage, on the other hand, will allow you to focus more on the long-term growth rather than the short-term market movements. Try to then avoid market timing, because the biggest mistake that most investors make is trying to time the market. Trying to buy low and sell high sounds very simple. A lot of people have tried and failed, but it's nearly impossible to execute consistently. So stick to long-term plans and focus on the company fundamentals, not short-term price movements. Okay, learn from your mistakes. So keep a journal of your investments and the decisions you make along the way, because reviewing your past decisions will definitely help you in identifying the patterns and biases in your behavior. And this will then allow you to make better decisions, obviously, in the future. Okay. Conclusions. How can we wrap it up? So to wrap it up, the key takeaway, I think, from Peter Lynch's philosophy is very simple, as we've stated many times. So it's simple. Hold on to your winners and let them grow. Okay. So the path to wealth is not about constantly trading or jumping from one stock to another. It's basically identifying great companies, doing the research, and holding on to them for the long term. So remember, don't sell too soon. If the business is strong, the stock price will follow. Okay? Even if there are fluctuations up and down, don't worry, stick to your stock. Then avoid emotional decisions. So don't sell because of short-term fluctuations. And trust your research. If you understand the company's long-term potential, let the market work the magic. Okay? And as I've said many times in the past now, and it's most importantly, remember that compounding works best when you give your investment time to grow. Jumping from one stock to the other only cuts your capital, also due to tax reasons. So every time you sell, you have to pay your taxes on it. And your investing capital obviously diminishes. So for many reasons, sticking to winners makes sense. So let the winners keep running and your wealth will follow. Most importantly, remember that compounding works best when you give your investments time to grow. I've said many times before, compounding is magical. And like Warren Buffett says, it's the eighth wonder of the world. So let your winners keep running and your wealth will follow. Okay, keep well. Have a great day. Bye. Bye to everyone. Bye.